There was a point where I had over $1 million of margin available to trade with. But then the market dropped over 10%. Volatility exploded. The margin requirement expanded for my positions. And almost overnight, all that margin availability disappeared. To be honest, I wasn't expecting that. And that experience last year changed how I think about investing. It changed how I think about risk. And it changed what a safe portfolio looks like for me. Because one important thing I've learned over the past 25 years of trading and investing, and that is that the biggest risks are usually the ones that you don't see coming. That's why in this video, I want to talk you through some of the investment risks that I underestimated, some of the mistakes that I made, what changed my thinking, and how I approach investing differently today. I'll also share with you a stock position which I'm currently down over 50% on. I'm going to talk you through why I still own it, and also why I become a lot more cautious when it comes to margin. And finally, I'm going to share with you one of the surprising reasons why some of my most boring investments have produced the highest yields. They've massively outperformed some other exciting investments. Here you see the first risk that I didn't fully understand until a year ago. I mean, I understood the risk of margin, but I didn't understand it as good as I understand it now. When I first started trading years ago, margin didn't seem that dangerous to me. It only took one market crash for me to realize that margin can be dangerous. But as you become an educated trader, you begin to use margin more wisely. And I've done that for many years now. But in spite of that, sometimes things just snap, they break, and something is exposed. And you realize something that you thought you had under control, that you thought you understood, is actually a little bit out of control. And so for a long time, over the past couple of decades, margin hasn't been that dangerous for me. Markets would pull back and then they'd recover. My available margin would go up and it'd go down a little bit. But volatility and my margin requirement, it all stayed pretty much in check. Because I had plenty of margin available every day, everything looked fine. This is an account where I keep a good bit of cash, but also will pull money out of it if I need it temporarily for a real estate deal. So cash does come in and out of this account from time to time. But in 2025, during the tariff tantrum, volatility exploded. And at that time, I was reminded of something very important. Risk can change very fast. But what was really impressive is how fast the margin requirement expanded in this account. As volatility exploded, my broker began to increase the amount of margin I had to have for the exact same positions. And that's while the positions were going against me. And that's the part that's easy for people to underestimate. One day you're feeling conservative, but a few days later, you're liquidating positions and wiring money into your account just to create breathing room. And your strategy is that you're hoping the market quits dropping. Back a year ago, this period of time, it was a bit stressful for me. And it's not because I thought the financial world was ending, but it's because I was reminded of how fast flexibility can change when you're using leverage. And what's interesting is that a few months ago, we had another volatility spike. But this time, it was a very different experience for me. I was using a lot less margin and therefore had a lot more margin available to me, as you see here. And as a result, my stress level barely changed during this volatility spike and market decline. The market was still down, and I didn't enjoy seeing my positions in the red. But emotionally, I felt completely different than I did a year ago. And that reminded me of something huge I want to make sure you remember. Sometimes the best type of risk management is simply making sure that when the market crashes, you can stay calm. One mistake I see investors and traders making all the time, especially option sellers, is chasing premium without respecting the underlying business. High premium can feel exciting. It can make you feel wealthy. But many times, there's a reason why that premium is so high. For example, this Campbell Soup position. Although it's a smaller portion of my portfolio, it's been a little bit painful. The stock has absolutely been crushed in price. And if all I cared about was stock price appreciation, I would probably hate this position. But this position also shows why I like dividend paying stocks. You see, this company, it still generates nice cash flow and returns. It still pays me a quarterly dividend. So while I wait for the market to figure itself out, I'm collecting those dividends and I'm also getting some covered call premium. Here you see that I own 1,100 shares of Campbell Soup. Against those 1,100 shares, I've slowly covered call below the price I was assigned the stock at. Now that would mean I'd miss out on a lot of stock price appreciation if Campbell Soup jumps way up in price. So to avoid that possible large loss, I bought a call option above the one that I sold. I sold the $21 strike price cover call option, and I bought the $22 call option. That means I only miss out on $1 worth of stock price appreciation if Campbell Soup goes way up in price. But I still get to collect nice premium, as you see here. I received on average $1.48 per share for those covered calls. And the protective call vault did cost me $1. So I pocketed about 47 cents per share. Pretty good for a $21 strike price cover call position. Structuring the position like this allows me to pocket some cover call premium, keep pocketing my dividends, but also benefit if Campbell Soup goes way up in price. This HTGC position is another great example. The position moved against me after I sold the May 15th $17 put options. Now I could have allowed those put options to be assigned to me a few days ago, but instead I chose to roll the strike price down as I rolled it out in time. And I was able to do that for a 5-cent credit. Not much, but it was a credit. And why did I do that? If I eventually get it assigned, I'd much rather own it at this lower $16 strike price than the $17 strike price. Like you, I want to buy stocks cheaper. This allows me to potentially do that. That's one thing I've learned over time. Good investing usually isn't about making perfect trades every time. It's about improving probabilities and reducing unnecessary risk. One thing the market has taught me over my many years of trading and investing is that boring companies can generate incredible returns. This utility company I'm showing you that I own here and that I've traded options in, it's not flashy. Nobody's making YouTube videos about EIX. As you see here in the total gain column, I'm up over 20% in less than a year in this position. And that's in addition to all the dividends I've been collecting, because right now it's paying just under a 5% annualized dividend. Same thing with this natural gas company, NFG. It's a very boring business. It's very steady in its cash flow and returns. But I bought it at a very reasonable valuation. And the total returns you see here has been awesome. Over 43% in less than 2 years. I think newer investors tend to underestimate this. A company doesn't have to be exciting to be a great investment, as you see here. Sometimes boring businesses create some of the best long-term wealth because the expectations are lower and so the valuations are more reasonable. Now, with that being said, I'm not against growth stocks at all. As you see here, I recently sold put options against Nvidia. And just a few weeks later, I was able to close this option position out for a very nice win. But during that time, I didn't just sell put options against Nvidia, I also bought a few shares. I did that because I thought the valuation was reasonable in spite of the projected tremendous growth Nvidia is supposed to have. And as a result, this stock position is up over 24% in less than a couple of months. But understand something about growth investing. Growth investing can do really well, but you have to be able to emotionally deal with the bigger swings that growth stocks tend to present. And this Lulu position is a reminder of that. I still think this company is very solid, but the market has punished this stock tremendously. And as a result, I'm down over 50% in this position. This is another reason why I prefer to invest in and trade options against dividend paying stocks. And the reason is that when things don't go according to plan, you still get paid every month or every quarter by receiving those dividends. So at least when this happens with my dividend stocks, I'm getting paid to wait. One of the biggest changes in my investing over the years is that I pass on a lot more trades than I used to. A lot of investing mistakes happen because people think they always have to be doing something. They always have to be doing as much as possible. They always have to be pushing the limits of how much they can make. This MasterCard trade is a good example of that. When I rolled the May put option, I could have rolled the strike price a lot closer to at the money. I bought back the 465 put, but I decided to go farther out of the money. I decided to go safer. I sold the 450 put option. Now, if I had rolled this May option out to July and kept that same 465 strike price, I would have received, I believe, double the income. But I rolled it down to a level that, given the recent MasterCard price action, a level I felt comfortable dealing with the stock at. And based on its current fundamentals and technical analysis, 450 is a price I feel very comfortable if I had to own MasterCard at. But if I had sold a higher put option to the 465 one, I would have received a lot more premium. But will I feel better knowing I sold this new put option at a level where MasterCard has been showing better support of recent? The answer is yes. I'm going to sleep better at night with this 450 strike price put option. No, I won't have quite as much cash in my pocket right now, but I will sleep better. And sleep is important. One thing I think a lot of YouTubers that talk about trading don't admit to, maybe don't do, is that after 25 years of trading and investing, I'm still aggressively trying to learn. Now, there's not as much for me to learn, but there still are things I can learn, and I love learning, hence the name of my YouTube channel. In fact, over the past several weeks, I spent a tremendous amount of time trying to tweak and learn a new butterfly type of trade. I already trade butterflies, but this one is a lot simpler and produces more consistent monthly income. And I'm very excited to learn this new trade, and I've been back testing it over the past week and a half, trying to figure out its vulnerabilities and what I can do to make the position better, to make it less risky, to design a trade that has less adjustments but still produces consistent monthly cash flow. No, it doesn't win every month. No trade does win every month. But this trade does appear simpler than some of the other option trades that I've been doing, so I want to learn it. I want to figure out its vulnerabilities, and I want to adjust them and make them better if I can, and then I'll begin to share those trades with my patrons. And that's one thing I love about investing. Learning with investing should never stop. To this day, even after trading for 25 plus years, I'm still trying to improve as an investor and trader. If there's one thing the market has taught me about investing over the past years, it's that investing isn't about avoiding every mistake. That's impossible. There will always be risk that we don't fully see or understand. But good investing does get easier for you when you respect risk, when you stay patient, when you avoid forcing trades or demanding that you find a trade to go into, and when you focus on giving your good decisions long enough time periods to play out. Because those good decisions, they will compound over time. So in the long run, it's far more important to avoid big, bad financial decisions than it is to find the perfect trade or the perfect investment. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. If you'd like to see some of the cover call tips and tricks that I share with my patrons, check out the video at the link above and the description below entitled Selling Cover Call Tips. Until next time, happy investing, and we'll see you again soon.